Hello, everybody. Welcome to the Enlightened Investor. We are back, the professor and the advisor. Mike, good to be here.
Great to be here, Josh. We're back. It's our second taping of the season. I remember when we first got started, we were so enthusiastic at gung-ho. I think we were like, every 2 weeks?
Every 2 weeks.
This is our second for the year, and we're almost into October. But what a great time of year to be filming. It's beautiful outside, so let's talk about money.
Let's talk about money. It's a fun thing to talk about.
bet.
Ben Franklin talked about it, so why can't we? We're going to talk today about why investors consistently miss out on market returns and what you can do about it, right? There's a recent study that came out that just kind of set the stage for everybody. Like, there's a recent study that came out from Morningstar that talked about, it's called Mind the Gap, and it just finds that regardless of year or season, it doesn't matter that investors persistently lose out to their basic, returns, or their total returns are on their end are failing.
Right. And it's common. I mean, they basically compare investment returns to investor returns, and there's always this gap between the actual investment and the investor. I mean, a good example, we did a video a while back on that, on ARK. And if people don't know that, that's an ETF. It's done incredibly well. It's run by the guru, Cathie Wood. Yeah. And the investor returns, if I remember right, were like negative, weren't they? Or some zero compared to the investment returns were phenomenal. So it's a behavioral issue. People shoot they're their own worst enemy.
Folks, we've been talking about behavior stuff, if behavioral finance and investing, I guess our whole time we've had the show. And, this is kind of a story about having a structured process, about having a plan and actually not touching or dinking around with your plan that you've been advised to do so professionally.
Well, and I'll put a plug in for us advisors. I mean, there's another study put on by Vanguard. And I think most people are familiar with Vanguard, but if you're not, I mean, they manage $8 trillion. So it's not a fly-by-night database or company. And they did a study, and it's very thorough, and they basically tried to combine all the data for how an advisor adds alpha or additional return, and it's like 3%. And a big chunk of that obviously is the behavioral side of it, but there's other things as far as the structure and the whole process of managing the portfolio to add value as well.
If people can't help themselves, so sometimes they can't help themselves to
get help, right? Get help, right? Yeah. But unfortunately, what's bad too, I think, was this. Even you probably still pick up some of that investment and investor gap if you have an advisor that doesn't follow a structured process or does follow an active picking, chasing type strategy, right?
Yeah, at lunch today we talked about how are these stock pickers going to keep competing against even improvements in like AI, right? Like, how are they going to? We have PhDs trying to. How are they going to?
Yeah, it's going to be interesting. Maybe some of them may capitalize a little bit better. You never know.
Possibly.
But it's still a narrow margin. But yeah.
Yeah, getting alpha.
Anyways.
Getting alpha is tough.
Yeah, for sure,
and
right.
And I think some people, especially younger advisors, they really go to town. So I guess it doesn't surprise you. Can you tell us a couple stories of like what you've seen where the study says over 10 years you lose 15%, which is massive.
Right. Well, I mean, I think if you go back, I mean, for me, I only go back as far as being a professional advisor, fee only, it goes back to about 2000. And if you think, you look back at 2000, you had the late 90s where you had the dot-coms, and everything with the dot-com behind it was making money hand over fist. Everybody and their brother was investing and making money. And that all came to an end in 2000. And a lot of people really lost a lot of money because they didn't get out and diversify, et cetera. But I see this, like again, another lunch conversation we had today, is I see that going on nowadays. You got a lot of people that have really made some serious returns and concentrated holdings in some of these bigger stocks. It was FANG, and now we call it the Mag 7. And history doesn't repeat, but it ought to rhyme at some point. I think if you don't take some chips off the table from being lucky and fortunate, we'll see where it goes. But I think it could end up poorly for a lot of people, like it did back in 2000.
Yeah, there's a lot of exuberance right now for sure, and people, learning about.
They all love the market.
They all love the market, and they're heavily invested in equities right now. I forget the ratio. I'm not sure if you can remember, but they're tilted heavily toward equities right now.
No rebalancing going on.
And U.S., they're tilted more toward U.S. instead of that. It's not recency bias, but home bias, right?
Home bias, I'm sorry. Well, kind of recency too, because it's doing well right now compared to international, so it's both.
True.
Yeah.
So I guess the question is like you want to, all you listeners out there want to figure out, how do I reduce this gap, this investor return that if you just, what are some solutions to it, Mike?
Well, I mean, it all starts with having a plan, and whether you're doing it on your own or whether you're getting a professional advisor to put it forth. I mean, and it's based on your goals, right? So then when you have a plan based on your goals, you're going to set a policy asset allocation, and on the highest level to control the risk, how much stocks you have compared to how much fixed income, and making sure your fixed income is investment grade and not speculative, because you don't want to take risk where you don't need to take risk. We're taking risk in the equity side. And then you get further and you obviously diversify it from the U.S. and international, and you break those down. You have value and you have small. And there's plenty of good books. And if you go back to some of our videos, we've had some of those that we've recommended.
Great
but
books out there.
A lot of good. It's very simple to do.
You know what? How about routine? Can you talk about routine? Like somehow, Mike's a big biker, everybody, and he has a routine that he rides his bike. He's actually out in the Badlands.
Badlands.
And he read over 100 miles one day. That was incredible. Right. You can't ride 100 miles unless you had a routine prior to going to the Badlands. So talk about that in a finance sense.
Well, when we're doing it for clients, we have a structured process. So we have it, like we mentioned that asset allocation, we've got it written up. And it's into the computer programs or in the software, so that if you drift from those percentages, we're buying or selling depending whether you're drifting up or down. And it's a process that's disciplined, and we're removing emotion from it.
Yeah. How about also, you just mentioned it before, but like people chase returns, right? Like recency bias,
right.
Really. That's another area where people get hurt. At least investors shaken if they chase and you chase
I
and
can
lose.
remember when I didn't know anything about investing, and if you gave me a list of funds to pick from, I looked at the returns, and if it was they all had 10-year returns, I wasn't buying anything with negative returns. Give me that stuff that's done really well, and the whole disclosure, it always says past performance has nothing to do with future performance, but I didn't know, and I don't think most people do. It's just what you do, right? How's my horse run, and I'm going to pick the horse that's been winning.
Yep. Well, how about this, Mike? Allocation funds are often used to help out with defined contribution plans.
Right.
Can you talk about that just a little bit?
Oh, they're a blessing. I mean, they're basically, because you can use, like with our plans, and most that are out there, hopefully, they use target date funds. So you target date based off of your retirement is a good place to start, even though if you still can't handle that much risk, it's probably not where you want to be. And they automatically kind of glide down slowly. But also, like with our 401ks, we provide clients with static asset allocation funds. So you pick your risk, and it stays there, and you don't take your foot off the gas until you decide to change your asset allocation.
I see.
I like that better.
Okay.
But
because
most of them just use the target date.
Yeah, the target date is really kind of a benefit too.
It's a good place to go. It's better than just taking a smorgasbord list and doing like I mentioned earlier, where you just start, because when you end up just picking funds, people are doing what I used to do. You're picking everything that had really good past performance. Yeah. You're avoiding the negative performance. Yeah. And probably what's going to happen right in the future, it's going to flip flop. The ones that have done poorly are going to do better than the ones that have done well.
Sometimes reversion to the mean, for sure.
For sure. So I think it's a great way to go.
Okay. Well, so sometimes less is more. It's
the complexity of simplicity.
Yeah, the complexity of simplicity.
Right.
Yeah. Any last thoughts on this, Mike?
No. Hopefully, maybe we'll do one more video before the end of the year.
Oh, yeah. Folks, thanks for being here today with us. It's been a joy to be back in the studio with you, Mike.
Yeah, it's good to see you today.
All right, the professor and the advisor. We're signing off.
Signing off.